Welcome to Thoughtful Money. I'm Thoughtful Money founder and your usual host, Adam Taggart, here, welcoming you back for take two of today's interview with Stephanie Pomboy. Stephanie, how are you?
I'm better. Thank you so much, Adam. And thank you for your patience with my apparent litany of technology problems today.
You talk about kind of the technology gods not liking you very much, and I think they took this as an opportunity to flex their muscles and show you how much they like to disrupt your life. But look, Murphy's Law, what can go wrong will go wrong. We can't control that, but we can control how we react. So we're soldiering through. If you watched the earlier and aborted take one of this, welcome back. This one is not live. It's being recorded here just between Stephanie and I, so we won't be taking any Q&A now. But as Stephanie has very generously agreed to do, when she comes on next in 2 weeks, we might run a little bit late, but we'll certainly take a lot more questions from the audience. So Stephanie, thank you again for soldiering through all this. We had two interrupted attempts by technology to try to get you to give your latest thoughts on inflation. And just to summarize very quickly for folks, you had said, look, the markets took last week's kind of only mildly softer, CPI data as a reasons to just unleash the animal spirits. And all of a sudden, folks aren't nearly as worried about sticky inflation as they were. You think that may be a mistake. Why?
Yeah, so thank you. Well, first off, the headline number at 4/10 annualizes to 4.8%. That's 2 full percentage points above where it was running in the 12 months prior. It's also 2.8 percentage points above the Fed's target. So that hardly struck me as cause for celebration. The real reason, obviously, the markets were excited was the core number, which was a little softer. But I thought it was kind of interesting that on the same day the market celebrated this slightly cooler core inflation print, as if they live in a world where no one needs food or energy, oil prices hit $80 a barrel. So, whatever cooling there was in the energy component obviously is temporary. Admittedly, oil prices are back down to like $77 a barrel now, but I think it's noteworthy that a lot of smart people have been forecasting that oil prices would head lower, and they have refused to do so despite a global slowdown in economic activity. And on the same day that this CPI number came out, a ceasefire deal announced in Gaza, and then a new administration that comes in and promises to end the war in the Ukraine. So all those things would seem to be reasons to send energy prices lower. And in fact, they are trending in the other direction. So long story short, I think that the markets were wildly amiss in terms of celebrating this or spiking the ball in the end zone, that inflation has been vanquished and now the Fed has free reign to continue on its way with rate cuts. And so I anticipate that the massive rally we saw in bond yields on this CPI number and the attendant rise in equity prices associated with it will probably reverse in the days and weeks to come as we see those higher energy prices start to creep into the gasoline price, and eventually that will be reflected in the inflation numbers going forward. It also bears note that if you overlay the CPI chart with the CPI, you overlay the overall CPI chart with oil prices, or even the core number with oil prices affect everything. So even if you're stripping energy from the CPI, higher oil prices will drive up the price of everything else. We know that. And yet, for some reason, we have this practice of assuming, well, it's just oil, therefore it doesn't matter. Outside of labor, it's the number one input into everything we consume. So,
Hey, Steph, in that, I don't have that overlaid chart, but when you do look at it, are oil prices the leading indicator between the two?
yes, in fact,
Okay.
if it's okay, I'll send you that chart that I have, and it lags, the energy component to show that it's about a 6-month, 9-month lag between energy prices and when they actually pass through into the CPI. So that's, it's one thing that people don't really focus on because we become so accustomed to excluding the volatile food and energy components. But again, even if you're not talking about gasoline that you're putting in your tank or using to heat your home, you buy a box of cereal and they're 50% of the cost of the box of cereal. That's my number, but a large percentage of the cost of the box that you purchase is energy prices, whether it be the energy to actually, till the fields and then, create the product and then put it in the package, and the lining of the box, that plastic sleeve has, oil in it, and then getting it to the store, and et cetera, and et cetera, so on and so forth. So long-winded way of saying.
just to provide validation of that, I mean, here's a headline yesterday from the Wall Street Journal: food prices are rising again, right?
Yes. Yeah.
So there are other factors going in there. Here they're mentioning things like bird flu, bad weather, and whatnot, but obviously increase in energy prices are part of that. So, as you said, everybody can cheer the softening in CPI as long as they all believe we live in a world that energy and food is unnecessary.
Yeah, absolutely. And I guess I would also point out that in that food thing, food prices hit a record high, not surprisingly. And then there was someone who's forecasting that egg prices are going to go up another 20% over the rest of the year. So again, this celebration seemed wildly premature. But ultimately, what it really comes down to is not the whether inflation's running at 4 or 3 or 2. It's where it's running relative to the consumer's income. And that continues to be a major issue that has not been overcome. In the latest Michigan sentiment survey, the number of people who expect that their income will actually outpace inflation this year fell to the lowest since the great financial crisis. So they're not optimistic that they're going to reap real income gains. And that presumably will serve to dampen their spending. And that's one thing, we did see the retail sales number a couple days later. And there again, so we had a 0.4 increase in retail sales. Well, that's exactly equal to what inflation was up. So if you buy the government's accounting of inflation, you're saying people didn't increase their spending at all in that month. I mean, they bought the same number of units. I'm sorry, let me rephrase that. They bought the same amount of stuff. They just kept
it just costs more.
Yeah, exactly. Kept up with the cost of everything going up. So that's another moving part to this drama, is the assumption that the consumer now is going to start to accelerate his spending. And, that rests on the idea that they're going to put the spending cart before the income horse. And they had been doing that. They had been running up credit card debt, but in the latest numbers we got on that, credit card borrowing collapsed. Huge decline in revolving credit in the latest month. So none of this adds up, to ratify the narrative that the markets seem to be running with right now.
Right. And on that last point, could you just clarify for folks? Some people might think, oh, well, consumers are taking out less debt. They're becoming more prudent. That's a good thing. Shouldn't we be cheering that? I believe you probably think that's no, they're not taking on more debt because they can't. They would like to, but they're beginning to struggle under the debt that they're currently under. Is that the case, or do you have a different explanation?
Yeah, no. Well, two things. Number one would presume that no one was borrowing on their credit card at 23% interest rates because they wanted to. You have to assume that people who are borrowing at that kind of exorbitant rate are doing so because they have no choice. And that kind of conclusion is sort of bolstered by what we've seen in the trend in multiple job holders and how people have had to work 2 and 3 jobs just to make ends meet. But also, when you compare what's happening with credit card borrowing versus the real retail sales activity that I referenced earlier, when people are slowing their unit spend and increasing their credit card borrowing, that's obviously a real warning sign. It would be one thing if they were increasing credit card borrowing and spending more, or taking vacations, or if confidence was soaring at the same time. But these are not things that we're seeing right now. Quite the contrary.
Yeah, and let me just ask about that for a moment. So we were going when we took take one of this discussion earlier today, we were going to cut it a bit short anyways because Murphy's Law intervening again when we initially scheduled today's recording, we didn't realize it fell right on the inauguration, right?
Right.
So we now have a new president versus when you and I talked a few hours ago, and we've seen a lot of confidence spike because of the new administration. This has been post-election. People think, okay, new administration that's very business friendly, et cetera. So we've seen like business confidence spike. We've seen consumer confidence in the markets spike in terms of
Mm.
their expectations of future market returns, but that stands in stark contrast to their expectations for their own prospects. So we see this real divergence where people are basically saying, man, I think I'm more worried about my job. I'm more worried about how much money I'm going to be able to save going forward and whatnot. But I'm super excited about stocks. And there seems to be a dichotomy there. I would love to have you comment on it. But they're getting super excited about stocks after the market has had two surprise back-to-back 20% plus years, right? So expecting that kind of momentum to continue is already statistically very low. And at the end of the day, a lot of consumers really don't own that many stocks. It's the stocks are over-owned by the very wealthy. So are we seeing, kind of some contrary and maybe almost sort of magical thinking going on right now by the consumer?
Well, I think this really brings me back to 2016 when Trump won the first time. And you did see at that point, and I think we may have talked about this in prior conversations, we were coming off of a really bad corporate credit crisis that was weighing on corporate profits and
Mhm.
hiring, and was hitting obviously consumers and confidence, et cetera. And then when Trump won and started implementing these pro-growth policies and the tax cuts and whatnot, the economy basically turned on a dime. So I think Wall Street's analysis has been, well, we just replay the tape to 2016, and if he implements the same policies, we'll get the same outcome. The problem is that valuations in 2016 were nowhere near where they are today. In fact, I think for the better part of 18 months going up to the election in November of 16, the S&P had gone nowhere. It had basically been dead money for 18 months. I mean, you couldn't come up with a more stark difference from today, where the markets have basically been flying, as you said. So even if you believe that all these policies will be enacted in the form that has been described and everything will be smooth sailing, at what price should assets deserve to trade? I mean, has this all been fully discounted at this point? And I would suggest it has been, and then some, because if anything, it's pretty clear already that it's not going to be as easy to get these programs implemented as Wall Street has imagined. And we saw that, in this whole speaker vote, et cetera. I mean, it seems like the Republicans aren't unified, and that could end up being a little bit of a problem. And now they're debating whether to have the tax cuts as part of one big, beautiful bill or have two separate bills, in which case, Wall Street's going to be sit there tapping its fingers on the table, waiting for the tax cuts through months of deliberation, which I would guess would be fairly nerve-wracking. So to me, it feels like there's been this anticipation of this perfect sort of nirvana scenario from valuations that were already extremely stretched, leaving basically no margin for error in a world where I think the prospect of error is extremely high. But that's me. I tend to be fairly cynical.
Okay, well, on just to tap into that potential cynicism, but if you don't feel cynical on this, please let me know. For those who are excited by the stated policy strategy of the incoming administration, what would your advice to them be? And kind of where I'm going with this question is let's give the Trump administration the benefit of the doubt. Let's say that it's successful in achieving its major economic policy goals over the next 4 years. Um, Assuming it is successful, do you think it can get there just by, incremental progress, that every step is a step higher, or will some of these things be disruptive at first and potentially so disruptive that they get in the way of the market's current everything is awesome always and forever narrative, and that we may have to see some either repricing of financial assets from their current euphoric highs, or that tariffs or whatever displacing millions of illegal workers that, yes, are here illegally, but they are working and they're working in core parts of the economy. Might we have some economic disruption that actually impacts economic growth in the near term?
Yeah, absolutely. Well, let me start by saying that I am excited about the policies of this administration, and I really share the optimism that they'll be able to be implemented in the manner in which they've been outlined. So I share all of that. I'm not in any way here to say, this is harebrained stuff, and I hope it doesn't succeed. Quite the contrary. I'm 100% on board with almost all of the policy proposals. That said, I do think that these policies are not without some negative consequence that we need to contemplate, at least in the near term. And I would say the most obvious is that if you're talking about sweeping deregulation, tax cuts, and these real pro-growth policies that are going to stimulate growth, you're talking about an environment where, as we just discussed, we have inflation above the Fed's target by almost 3 full percentage points on the current run rate. That's probably going to continue to be moving out of reach rather than toward them if growth is accelerating. And that would suggest an environment where the level of interest rates will be higher for longer. And to my mind, that is the single biggest risk to the markets that people aren't focused on. And I know I'm a broken record, and we've talked about this a million times before, but the impact of higher for longer interest rates is so massive, so widespread, and negative for corporate profits, for credit quality, for basically everything. Who knows what happens in the financial sector? We have this massive shadow banking system, private credit, private debt, that relies on mountains of leverage, and we have no visibility into what's going on there. But presumably the credit quality deterioration we're seeing in the public markets is every bit as bad, if not worse, in that segment, with potential repercussions that are unknowable, but surely not good. So I think that's the biggest concern I have, is that we end up having pro-growth policies that are bullish for the economy, but end up being very negative for financial assets because they sustain higher interest rates on an economy and financial system that's just so incredibly levered, that becomes an issue. So I have to separate my optimism about the economy from what I view as a major headwind to the markets. But as relates to your points about the cost of deporting illegal aliens. Obviously, I think about my landscaper here. Everyone who works for him is an illegal alien, and I know that if he has to hire people who are documented, my monthly landscape bill is going to go up a lot, because he's going to have to pay these people a lot more money, and not to mention doing all kinds of additional paperwork, I'm sure. So and that too will be inflationary in the near term. In the long run, sure, it'll be great because it'll get more people who maybe have given up on looking for work in off the sidelines, and help boost economic activity organically here in the country. But there are a lot of near-term costs to implementing these changes.
All right, let me ask this question. I can't recall if I've asked it of you yet, but I've asked it of many guests. and I know you're not a political analyst, and I know that you don't know Trump personally, but a lot of people remember Trump's first administration, and he would use the stock market as more or less of a scorecard.
Yeah.
And so I think there's an expectation amongst some that, well, they'll never let the stock market correct because, Trump's ego won't allow that, or that's the benchmark that he has the world judge his performance or whatnot. Um, I'm going to munge a few questions into one. One, do you think that's the case? Or do you think, kind of the standard playbook is you get in office, you kind of hope and kind of help markets kind of correct because it brings things down to a more sustainable baseline. You've still got the goodwill that you're riding in on. You can blame it all on the previous
Mhm.
guy. So, a lot of people I've talked to, and this was my initial advice when I thought of this, is, Trump really should be, if I were advising him, I'd be saying, hey, start the messaging now. Now that you're in, the mess was way worse than you thought it was. Tell
Mhm.
everybody it's a great thing you're here and you've got such a great plan, but it's going to take a while to get to the promised land. And we're going to have to soldier through this together, and we're all going to have to tighten our belts and whatnot. So, do you think, so which one do you think Trump's going to adopt more? The latter, or is it going to be back to Trump one of just, hey, do everything we, calling every time the market dips, he's calling up Jerome Powell on the phone
Right.
and banging on for QE or lower rates or whatever.
Well, you put me in the impossible position of separating what Trump should do from what
Hmm.
he will do.
Yeah, and I understand I'm asking you to guess on this. This is
Yeah.
just speculation.
And again, I'm not a political analyst. And as you said, I don't know the man. But as intellectually uh, smart as smart as it would be for him to message the way you described and to let the markets, you know, uh, cleanse themselves of the excesses and then hope that in the second half of his term, there's a rebound and everything ends on a really spectacular note that becomes his legacy. I don't have any great confidence that that will be his reaction to a decline in equity prices. I think that, as you said, he does view that as a barometer of the health of the economy. And while I think it would be easy for him to pin the blame on the prior administration and say, we inherited this mess and we're going to have to do some serious belt tightening and it's going to be hard. I just don't know that that's really in his DNA. So
Hmm.
I guess and I do remember, of course, in 2018 where he was threatening to fire Powell and saying we need lower interest rates, we need lower interest rates, and eventually he called Powell into his office, and the next thing you know, the Fed pivots. So could that happen again? I wouldn't rule it out. Obviously, my heart would be in the scenario that you described, where we actually take the pain and put on our big boy pants and actually recognize that we're long overdue for this, and it would be better to get it out of the way quickly. And also, if we get into a situation where we're constantly going back to the Federal Reserve to bail out the stock market, it just makes ultimately the day of reckoning far worse. I mean, at this point, how many times have we kicked the can down the road already?
Right. Well, let me ask you this, Stephanie, and then we'll start wrapping up here because again, I promised you that we would let you tell the full inflation story, but then everything else we can save for your next appearance here on your new biweekly show. Um, so inflation is proving sticky. You've just shared your thoughts with us that you think Wall Street is being overly optimistic here. Um, do you see where do you see inflation going from here? Not just even in the short term, but kind of in the next couple of years. Jerome Powell is definitely telling a story of it's taking a little bit longer than we want, but all the data is showing us that the trends are in the right direction, and we're just going to let time take its course here. We've had some other folks on this channel. Lacey Hunt will be back on in just 2 weeks to give us his latest update, but he looks at his standard metrics, largely how the money supply shrank, back over the past current years. And he just says you can't get away with a free lunch from that. the cost of that is the economy must slow, and he thinks that disinflation will eventually win out. We've got guys like Lance Roberts and his partner, Mike Leibowitz, who have done a ton of math on this channel, so I won't go through it all, but they're basically saying, if you look at kind of the standard correlations, inflation is going to have to come down as well. That said, there's a lot of other people saying, no, I think inflation is going to be stickier. It's going to keep yields higher, as you said earlier. And they see more of like a, potential 1970s style where inflation goes up and then the Fed has to go back into inflation fighting mode and it comes down, but then maybe it rises again. Do you have a particular trajectory that you're expecting here around inflation?
Well, I guess I'd make two quick comments. The first is in the very short term, and maybe this is one of the things that's gotten Wall Street excited, the math year on year is such that the headline CPI should move lower through April. So we've got 4 months where
and
we
this
will
is base effects where you're comparing it
exactly,
to, yeah,
because we're comparing it to very hot inflation readings this time a year ago. Year on year, you'll look for some tailing down in the headline inflation numbers, which is, of course, irrelevant in the big scheme of things to real consumers, et cetera. But that's just one thing to acknowledge at the outset. So if people see the CPI numbers starting to cool, and they don't say, oh, Stephanie, you're such an idiot, you thought it was going to go up. I'm talking about sort of in the broader sweep of things, the lagged effect of higher energy prices. But I think that from my standpoint, I have a real weakness, as you know, for Lacey's argument about the massive amount of debt and how deflationary that, coupled with our demographic situation, is in a secular framework. The question is the cyclical side of that, because within a secular downturn in inflation, you can have cyclical ebbs and flows, obviously. And we were clearly in a situation where cyclically inflation was picking up. Now it's in a cooling phase. Will it pick back up again? I think there's reasons to believe, mostly because I see this shift to commodities inflation that will push through the CPI numbers. But as we've also talked about at length, my sense is that we're reaching the point where that kind of inflation can't continue to be passed along endlessly to consumers who just don't have the wherewithal to absorb it. So I do see inflation as more of a PPI, an input inflation phenomenon. I think there are limits to how much farther the CPI, consumer prices, can rise before it just can't rise any farther. Consumers can't keep up. But ultimately, my sense, and one of the reasons why I've had a weakness for Lacey's view, isn't just the debt and demographics, but the risks that I talked about, that if you have this situation where we're talking about a market that's succeeding to higher interest rates for a longer period of time, and that takes some air out of the stock market and risk assets in general, that will have a real disinflationary impact on the headline readings. I mean, remember back in 2000, people forget this, but just before the Great Recession in 2007, I think December 2007, inflation was 5.6%. CPI was 5.6% year on year. I mean, we think that inflation was 2 for our whole lifetimes, but it was actually 5.6. A year later, it was -2. So that's how quickly the collapse in equity prices and risk assets was able to feed through to goods and services inflation. Just people, that reverse wealth effect is so profound, whether it's psychological or actual, that you could see some cooling of inflation there. But I think between now and that point where we hit the break point, I would expect to see inflation just be stubborn. I mean, I'm not necessarily even saying it's going to go much higher, but if it refuses to go down, that's a problem for the Fed.
Right. Because it keeps things higher for longer, both in terms of prices and more importantly, probably even bond yields. Okay, so
absolutely.
So let me just ask this on inflation, and then we'll start to land the plane here. So the biggest component of CPI is shelter, right? I think it's like 40% or so ish. So in many ways, as shelter prices go, the CPI goes. And it's taken a lot longer for that data to start coming down, that component to start coming down. And there are a whole bunch of reasons for that, but home prices tend to be, the shelter inputs to CPI tend to be some of the most lagging inputs into the equation.
Yeah.
So some people that are pro inflation getting tamed just say, hey, look, that trend has started, and sure, maybe other prices might go up, any given month along the way. But if you've got housing kind of cooling, that's just going to be dragging that whole thing down with it. What are your thoughts on the shelter component?
Well, I agree with that. I think it has been a factor in pulling down the inflation numbers. And then we're reaching a point where we're going to get to that inflection where, in the home prices did start to come down and then you turned back up again. So I think we're reaching the point where, as unsatisfying as the decline has been, its impact, it may have run its course already and we're starting to move higher again. But the other part of it is, even if we've got a little more downside to come, with interest rates higher for longer, you're just locking up all that inventory still. The market will remain frozen. So you won't have that clearing that actually I would have thought perversely that lower interest rates would have led to lower home prices, because you finally would have been able to move and you would have seen a lot more supply on the market. So my sense is that it's a little bit of a push-pull situation. And I think that those higher rates could really keep the market frozen for a while and not give us that satisfying decline in the shelter component that everyone's looking for.
Okay. Well, look, I've got a ton of additional related threads that I'd love to pull with you, but we're just going to save those for your appearance here in 2 weeks, because I promised you I'd let you get the inflation stuff done and then let you get back onto your life here. But lots and lots of questions about market direction and things like that. I do maybe just want to make sure I'm understanding your general view correctly, so that when you're back on in 2 weeks, we can start there, which is you say that you think inflation's going to be, I sort of hear you say, look, folks, don't discount inflation. It's probably going to be around for longer than you would like. But that's in the things that you need to live your life.
Yeah.
Sadly, prices are going to be high. In terms of asset prices, I believe you think that the risks, at least this year, I'm not saying next week, but this year, the risks are much more to the downside. You could call that disinflation in financial asset prices. Am I capturing your outlook correctly there?
Absolutely. Yeah, I definitely think that will be the case, that inflation in the economy will beget disinflation in financial assets. And, we started to see the beginnings of that last year, with commodities, or gold in particular, outperforming the stock market. So it's clear that you already have an environment where, in real terms, paper assets are losing ground. So now the question is, will we reach a point where in nominal terms they start to lose ground? And I think they may, but for sure, in real terms, we'll have another rough year, I would expect. So, and you
Okay.
don't need to apologize for me for my time. I'm the one who needs to apologize to you for these technology interruptions. And next week, in 2 weeks, I'll be coming to you via my new computer, hopefully. Oh my gosh.
Well, look, you've been such a great sport, Stephanie, and that's so visible to everybody. They can tell right now you're actually on your iPad. So when your computer died earlier today, you went and jerry-rigged this current solution. It's been fun to see a different part of your house. Everybody's so used to your well-accoutred office there, but now they get to see another part of your house. And I believe Wilhelmina must.
She's right here. I don't know if you can see her down here.
There we go, because I could definitely hear her a bit during the discussion.
She saw me come in here and settle down, and she had to be part of the program. So There
All
you
right. Well, look,
go.
thank you so much for finding a way to,
Yeah.
Rube Goldberg-esque pipe in here and deliver the message that folks were so excited to get. So anyways, thanks so much, Stephanie. It's been wonderful. Everybody watching, set your calendars for next Monday, or sorry, 2 Mondays from now. As a reminder, Stephanie's new show here, this is the second one. Uh, it releases every second Monday at 11 a.m. Eastern. And we've said if these things go well, we'll make this a regular occurrence going forward. I hope today's troubles don't get in the way of it going well for you, Stephanie, because I know folks have really enjoyed even the aborted attempt we had before, and I know they're really going to like this. So hopefully you hang in there, and hopefully better days will be ahead here.
Well, I'm just glad that we agreed you would hold my hand until I got my bearings on this, because today would have been an unmitigated disaster if you got me there to step in. So, oh my gosh.
It's all good. Well, folks, please show Stephanie your appreciation for soldiering through here by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. As always, if you want some help in figuring out how to position your portfolio for what may lie ahead, especially if the things that Stephanie thinks are probable indeed do happen. If you want some help from that, you can get it from a good professional financial advisor. If you don't have one of your own, just go to thoughtfulmoney.com. Fill out the short form there to be connected to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week after week, week in and week out. And they'll be happy to help you in any way they can. As a reminder, these consultations are totally free. There's no commitments. It's just a free public service they offer. Stephanie, as usual, so wonderful to have you here. I resisted the urge to ask you more specifically about the policies of the new administration. And the reason why is because there are something like 200 executive orders, I
Yes.
think, getting signed as we speak, right? So I'd like to give you the chance to let the dust settle, read through them and whatnot. But next time you're on, it'd be great to see if there are any particular ones in there that you think will be particularly impactful for the economy within the coming year, either on the positive side or the negative side, if that's okay.
Yeah, absolutely. I look forward to
All
it.
right. Well, Steph, as always, just so fun, so wonderful to talk to you again. Thanks for rolling with all the punches here. Everybody else, thanks so much for watching.
Thanks, Adam.